So I think the first questions it talks about is really a test on your understanding of what do you all understand by the YA concept, and how to determine the year of assessment, which is always the basis period on the year of assessment. Okay, so over here you can see that that for YA, okay, the company was incorporated on 29th of March 2023, and the first financial period will end on 30th June 2024. Okay, so what we have here is that this period uh, for the first YA 2024, okay, the basis period will be from 29th of March 2023, okay, which is the incorporation date, all the way to 30th June 2023, okay, because that is the first financial year. And then for YA 2025, it will start from 1st July 2023 to 30th June 2024. Okay, so that is where there are uh, two basis period for the period from 29 March 2023 all the way to 30th June 2024. Okay, and it's been split between YA 2024 and YA 2025. Okay, so since the question asks about what is the basis period for the year of assessment 2025, then the preceding period will be from, the answer would be B, okay, which is from 1st July 2023 to 30th June 2024. Okay, yeah, I will continue to move on. Then, if any one of you have any question, either you unmute yourself and ask it, and raise them online, or you can type it on the chat box. Then on question 2, okay, is the main objective is to test, when you file your tax return and you want to pay by installment, okay, what would be the installment on the ECI. Okay, so the when you file your ECI, okay, you have to, the maximum installment of 10 will kick off if you file your ECI on the 26th of the following month, okay, you will get 10%. And if you file the ECI on the 26th of the second month, okay, the installment would be reduced to 8%. And if you file it on the third month, it will reduce to 6%. And then after that, if fourth month and beyond, there will not be any installment. Okay, so in order for you to maximize the number of tax installment, which in this context will be 10, okay, you would need to file within by the 26th of the first month of the close of the financial period. So given that the company finalize its financial period on 30th June 2024, then in order to maximize, in order to get the 10 installment, it has to file by 26 July 2024. Okay, don't ask me why 26. Okay, the date is actually set up by IRAS. So if you go into IRAS website, you will see that you have to file everything. You have to file in order to be eligible for any installment. You will have to the filing date is on the 26th of the following month. Okay, so on part 3, the answer is B. Okay, the statutory deadline. So you will have to file for the period, for the financial period that is ending 30th June 2024, okay, that would be YA 2025. So for all YA 2025 tax return, the deadline, the filing deadline will be 30th November 2025. Okay, so I think the question 1, 2, and 3, the main purpose is they are technical questions, theory questions, basically to test your understanding on how much do you understand on the compliance basis. Okay, what do you mean by year of assessment? How you determine year of assessment, which is based on the preceding period. Okay, and then what would be the filing deadline, and also when you file your ECI, you want to maximize your cash flow by paying through installment. So what is the maximum installment that you want to get, and when do you need to file your tax return to be eligible for the installment? Okay, so before I move on to case study number 2, question 6 to 11, I pause here for a while. Any questions? Okay. Yeah, then if there's no question, let's move on to case study number 2. Okay, so this is quite a long, I would say this is quite the case study is quite a handful. There are quite a few facts that we are trying to test you. Okay, so what this company, Spear Private Limited, SPL, is in the business of manufacturing furniture. Okay, and it has a financial year, September financial year. Okay, so for the financial year ending 30th September 2024, what I will always do is that I will write down the financial period. So for the financial year ending 30th September 2024, that will be from 1st October 2023 to 30th September 2024. And this is for YA 2025. Okay, tax year. Okay, so if you look at the income, the company derive a few category of income. So the first bullet point shows that it earns the business income. That means we typically call it the Section 10(1)(a) income, which refers to its trading income. Okay, and then it also generated on the second point, that would be foreign dividends. Okay, and then the third one would be dividends income, and then it also generated foreign interest income, and also foreign rental income. So always tell yourself that whenever you see the question asking you on foreign testing you on foreign income, okay, basically it's trying to determine whether, okay, will the foreign income be taxed in Singapore? Because you all know that typically foreign income like dividends, foreign dividends income, foreign interest income, or foreign rental income, they would only be taxed in Singapore if they are received in Singapore. Okay, if they are not received in Singapore, meaning that they are kept outside of Singapore, then they will not be taxed in Singapore. Okay, number one. And then secondly is that there are certain category of foreign income. Okay, even though they are received in Singapore, they are not taxed in Singapore. Okay, and they falls under what we call the FSIE scheme, foreign source income exemption scheme. So income like dividends income, service income, branch profits, if they meet certain qualifying conditions, even though they are received in Singapore, they will not be taxed in Singapore. Okay, so these are mainly, when you see foreign income, okay, the main question that you will need to ask yourself is whether would this income be taxed in Singapore or not. Okay, so the question number 6, which of the following income would be subjected to tax in SPL tax return for YA 2025? Okay, the answer is interest income of 200,000. Why? Okay, so let's look at interest income first. Okay, so you can see that the interest income, although it's a foreign interest income, okay, and SPL did not remit the interest income back to Singapore, but what happened was that SPL used the interest income to purchase equipment, okay, and then brought the equipment back into Singapore on 29 September 2024, which still falls within the financial year, okay? And you all know that, under the concept of received in Singapore, there are 3 kind of situations that will be considered as received in Singapore. One is, you bring the money back into Singapore. Secondly, you use the foreign income to settle, your foreign trade debts. Okay, and number 3, okay, which is in this case, you use the foreign income to buy an equipment and you bring the equipment back to Singapore. This would also considered as received in Singapore. So it is considered as deemed received in Singapore. So that is why interest income is subjected to tax in the interest income of 200,000 is subjected to tax. Okay, the dividends income. Why the dividends income from TPL, okay, is not subjected to tax? Because this dividends income would qualify for the FSIE scheme that I mentioned earlier on. Under the FSIE scheme, if the dividends income is being paid out of a country where the headline tax is more than 15%, is equal to 15% or more than 15%, okay, and the income has been subjected to tax in that country. So over here we see that country A, okay, the headline tax is 15%, so it meets condition 1. And secondly, the dividends income is subjected to 15% withholding tax. So given that this meet the FSIE scheme, even though it is received in Singapore, it would exempted from tax under the FSIE scheme or under what we call Section 13(8). Okay. Then secondly, dividends income of 150,000, okay, which is this one. Okay, you all know that Singapore dividends is not subjected to tax in Singapore. Let me see. Yeah, so this one is very straightforward. It is not subjected to tax. And then the rental income, okay, 50,000. Why the rental income is not would not be subjected to tax in YA 2025? Because it was only remitted back on 31st December 2024. Okay, it passed the financial year of 30th September 2024. Okay, so it would only be taxed in YA 2026, the following YA. Okay. Then the other part is, which of the following statement is true? Okay, the answer is C. Okay, the revenue derived from customer in Malaysia is treated as a Singapore source income and is subjected to tax on an accrual basis. So if you know that, under the Singapore Income Tax Act, Section 10(1)(a), which talks about your trading income. So long as it's your trading income, it will be considered as a Singapore source, and it will be deemed as accrued in Singapore. Okay, this is clearly set up in our Income Tax Act. Okay, it is unlike other income like rental, interest, dividends. It would be if the income is not accrued in Singapore, if the income is not a Singapore source income, but from overseas, then it will only be taxed when they are received in Singapore. Okay, so but for Section 10(1)(a), which is your trading income, so long as this is part of your trade, you will be subjected to tax, regardless of where the customers are based. Okay, so for the next one, okay, question 8. Okay, SPL is intending to claim the amount of actual rental expenses incurred in respect of the investment property. Okay, in this regard, what would be the net income that will be subjected to tax when the income is remitted back to Singapore? Okay, so mainly is that to compute the rental profit that will be subjected to tax, you use the rental income less away any expenses that are incurred for the rental income. So if you look at the question, okay, we know that the rental income is 50,000. Okay, and oh yeah, the other thing that I want you all to take note is that when you are reading the question, look at this rental income. Is it the gross rental income or is it net rental income? Okay, because if it is net rental income, what this means is that this amount has been subjected to withholding tax. Okay, so when you compute the rental income, you need to regross the amount out. Okay, but in this situation, the question said, is a gross rental income. It never used the word net. So we can safely assume that this 50,000 has not been, withholding tax has not been deducted. Okay, so we know that the rental income is 50,000. So you can deduct, the expense, 12,000. Okay, and you can also deduct the property tax. Okay, why you cannot deduct, the refrigerator of 2,000? Okay, the reason is because this refrigerator is capital in nature. Okay, it is capital in nature, so capital expenses cannot be deducted for tax purposes. So that's why you take 50,000, less away 12,000, and less away 5,000, which is 33,000. Okay, and then you do not less away the withholding tax of 10%, because this withholding tax, is not a deductible expense also. Okay, but you can, claim a foreign tax credit against, against the net, against the net against the rental profit that is subjected to tax. Okay, then on question 9, okay, SPL noted that rental expenses can be claimed on a simplified basis in respect of the rental income. Please advise which of the following statement below is correct. Okay, whether can you claim 10% of gross rent, 15% of gross rent, okay, or 20% of gross rent, or none of the above. Okay, the answer is none of the above. Okay, because only individual, okay, such as sole proprietors and partnership, can claim this, can elect, for the simplified basis, okay, against the rental income. Okay, for companies, this exemption or this simplified basis is not allowed. Okay, before I move on to question 10 and 11, any clarification or question that you have on what we have discussed earlier on? Okay, then if there isn't, then let me move on. Okay, so according to the tax treaty between Singapore and country A, there is a reduced withholding tax rate of 8% in respect of dividends. Okay, what can SPL do in order to avail to the reduced rate of 8% on its dividends income received from TPL? Okay, so the answer is B. Okay, SPL should, reach out to IRAS, Inland Revenue, the Tax Authority of Singapore, to apply for a certificate of residence to prove that, SPL is a Singapore tax resident. Because only if you are a Singapore tax resident, then you can elect for the lower reduced withholding tax rate under the tax treaty. If you are not a tax resident of Singapore, then you cannot rely on the tax treaty. So SPL, should be the one to apply for the tax resident certificate. Okay, so the answer A, C, and D, is not applicable. Okay, during the year 2025, SPL changed its financial year end from September to December. Okay, what would be the basis period for SPL in respect of the year of assessment 2026? Okay, so what this means is that SPL wants to, change its financial year end from September to December. So that would be 15 months, okay, 15 month period. So what this means is that you can, file your that means your YA 2026 will start from 1st October 2024, okay, all the way to 31st December 2025. So essentially, you will be filing a 15 months period. Okay, so this is an option that you can elect. If you don't want to elect this option, Then, another way is that, you file two income tax return, one from 1st October 2024 to 30th September 2025. Okay, and then after that, you file 1 October 2025 to 31st December 2025. Okay, you either elect, an extended 15 months period, or you file two tax returns. Okay, any question? Okay, then, let's move on to the other case study. Which is covers from question 30 to 37. Okay, so for the year ended 31st December 2024. Okay, so we know that this is for YA 2025, and the basis period will be from 1st January 2024, 1st January 2025 to 31st December. No, sorry. It will be from 1st January 2024 to 31st December 2024. Okay, so this is the basis period. And then during this time, SPL make an acquisition and acquired a company called TC. Okay, and TC is based outside of Singapore. So again, similar to what we had gone through earlier on, there's a dividends income, okay, from TC. So this is a foreign dividends. Then the first thing that comes into your mind is that whether is the foreign dividends, should the foreign dividends be taxed in Singapore or not? Okay, so we know that the dividends is received on 9 November 2024, which falls within the basis period, and the headline tax is 25%. Okay, and then we know that dividends income is paid out of your profits. So the profits, we assume that it may be taxed in Singapore. No, the profit has already been taxed in country T, but we will have to continue reading to see whether is our assumption correct or not. Okay, if our assumption is correct, then clearly these dividends would not be subjected to tax, even though it is received in Singapore, because it will have, number one, met the headline tax, which is more than 15%, and number two, it will be subjected to tax because the dividends is paid out of TC after tax profits. Okay, then you also engage in this is a fee from an overseas client, okay, that SPL provided to them, and this overseas this is part of its business of providing as a service provider. So this would fall as part of his business income or trading income, okay, which if we look at what just now we mentioned, it is part of this business activity, principal business activities. Then, the other part is interest income. Okay. Also foreign interest income. Then, another foreign interest income. And we know that this foreign interest income, SPL declared an interim dividends of 60,000 for its shareholder. And then it used country Z bank account interest income to pay the dividends to Mr. Kirk, okay, a country Z tax resident who owns 25% shareholding in SPL. Okay, and then after that, it received it won a case against its vendor, okay, and received a legal settlement of $8,000. Okay, then the expense that this company incurred will be depreciation, and then there will be some staff costs. Okay, and one thing that I want to emphasize is that, when you see medical things like medical, and then you know that this is portable or not a portable or transferable medical plan, then what that you comes into your mind is that these medical expenses, okay, you need to whether is it deductible against 1% or is it 2%. Okay, and secondly, you also need to determine, okay, what is the definition of medical expenses. Okay, because there are certain items that falls within the definition of medical expenses, and there are certain medical expenses that are not considered as medical expenses. Okay, and then the third one would be that you need to consider is the remuneration. What is the definition of the remuneration? Okay, and then over here, you have the write-off of obsolete fixed asset, and you also have forex exchange, and part of the general office expense. Okay, there will be a machine. There is a machine that is imported from Italy for staff use. So when you see this coffee machine, straight away, the thing that comes to your mind is that this is a capital expenditure. So capital expenditure, if you have to add back, it's not deductible, but you can claim a capital allowances. Okay, and then you have the maintenance and repairs, which is part and parcel of maintaining the coffee machine. And you also have interest expense that is used to for various factoring of the accounts receivable, and also for lending, for incurring bank loan to purchase servers. Okay, then other information will include office furniture. Okay, and whenever you see fixed assets where the cost is quite low, I think 4,000, like for example, in this case, 3,000. The first thing that comes into your mind is that would this qualify as low value asset CA or not? Okay, if it does, then straight away you can claim under low asset value CA. Okay, and then you have the computer server IT, okay, which is 100%, and then you have, renovation, repairs and renovation work. So when you see repairs, renovation work, the thing that comes into your mind will be, your section 14N deduction. Okay, so typically, in the past, if this is a paper form, when you see this type of question, it's the intention is for you to prepare a tax computation. Okay, but because this is a MCQ question, so it is being structured, differently. So then, let's go through the MCQ question, and this will give you a flavor of what to expect, in the coming foundation exam. Okay, so the first part is, which of the following statement regarding the 350,000? Okay, this 350,000 is the company trading income. Okay, so when you remember just now, as we talk about trading income, you would even though the customer is based outside of Singapore, and the money, is not received in Singapore, but because this is your trading income, it will be deemed, as the income is Singapore source and accrued in Singapore. So in this context, okay, the answer is 1 and 3. 1 is because it is taxable in Singapore as it is a Singapore source income. And 3, okay, even though, okay, the income is, kept outside of Singapore, but because this is a Singapore source income, and it is, it will be deemed as accrued in Singapore. Okay, so that is why even though the money is not physically received in Singapore, it does not matter. You would still treat this as taxable in Singapore. Yeah, so in this context, 2 and 4 is not the right answer. Okay, so you can see that under statement 1 is correct because it is considered as performed in Singapore, and hence it is sourced in Singapore. And of course, 3 is also similar as statement 1. So 1 and 3 are the right answer. Okay, then the next part will be the 15,000 interest income from the deposit in the country Z bank was tracked separately by SPL and was never remitted to Singapore. It was fully used to pay the dividends to Mr. Kurt and was paid out directly from the overseas bank account. So we know that everything about this 15,000 interest income was based offshore. It was never received in Singapore. Okay, even when it used to pay the dividends, it used, from the overseas bank account and paid to Mr. Kurt. And Mr. Kurt, you can see that over here, Mr. Kurt is a country Z tax resident. Okay, so we know that the interest income was 100% based outside of Singapore and never remitted back to Singapore. So in this backdrop, okay, the correct answer is D. Okay. And then just for discussion purposes, whether the shareholder is a Singapore tax resident or not is not a deciding factor. Okay. The main thing here is it would only be subjected to tax in Singapore if the income is received in Singapore. Okay. So given the fact that the interest income, I think if you look at the fact pattern, you can clearly say that you can clearly argue that that amount was never received in Singapore at all. Okay, in 2024, TC declared a dividend of 160,000 and remitted the amount to SPL bank account in Singapore in the same year. Which of the following statements about the Singapore tax treatment of this dividends income is incorrect? Okay, it's asking you about incorrect. It's not on correct. Okay, so the dividends is non-trade income in the hands of SPL, correct? Okay, this answer is correct because a dividends, the company is not in the business of investing in shares. Okay, it is in the business of providing services. So dividends income is considered a non-trade income. Okay, and then the dividends income is automatically taxable because it has been remitted to Singapore in 2025. Okay, this answer is incorrect. Okay, because as I mentioned, okay, just now, the dividends income, although may be received by SPL on 9 November 2024, it could be exempted from Singapore tax if the foreign dividends income qualifies under the FSIE scheme. Okay, and under the FSIE scheme, it means that the headline tax must be at least 15%, and the income has been subjected to tax in that country. Okay, so in this context, the headline tax is 25%, and as you know, dividends is paid out of after-tax profit. So the amount has already been taxed in country T. So possible that the dividends income, you have to analyze whether the dividends income is taxable or is it exempted. So this is incorrect because the word is automatically. It is not automatically taxable. You need to analyze whether it falls under the FSIE schemes or not. Okay, the dividends is not taxable because all dividends received by SPL qualify as one-tier dividends. Again, this is not true because as the only dividends that are paid out by Singapore residents would qualify for one-tier exemption. Foreign source dividends do not qualify for that one-tier dividends, or they are not really one-tier dividends. Okay. Yeah, Cassie, you have a question?
Yeah, hi. I was a bit confused with the interest rate that is not remitted to Singapore, that is not subjected to tax. But when we go the question 30, when you're going through the fee that we received, like when the overseas project, but the fee is not remitted to Singapore, it's still taxable to Singapore, is it?
You mean the service fee, correct? The
Correct.
350,000.
So the service fee, it will be determined by the source. It's like
Yes.
this provided by Singapore.
Yes, because this is part of this is considered as its trading income.
Okay, so it's trading income, then it's considered from the source perspective.
Yes.
If it's interest, then it's remitted or not.
Yes. So basically is to really I mean, if I want to teach you an easy way, okay, it is okay. Income that is from your trading income is based on source. Then any income that is not your trading income, okay, would be based on whether you receive in Singapore or not, especially if these are foreign source income.
Okay, that is nice. That's nice tips. Thank you. Yeah.
Okay.
Yeah, that's all. Thank you.
Yeah, pleasure. Yeah. Yeah. Okay. So to continue, so part 3 is also incorrect. Okay, because the foreign income is not one-tier dividends. Okay, and then finally, part 4, the dividends income may be exempted from Singapore tax if all conditions under the foreign source income exemption scheme are satisfied. That is correct. We have been talking that quite a few times. So for this particular answer, which are wrong is 2 and 3. Okay. Yeah. Okay. So now let's talk about the medical expense adjustment. Okay. You all know that for medical expense, there is not 100% will be deductible. Okay. It will be determined by whether this is a portable scheme or this is not a portable scheme. Okay. So how do you compute the calculate the medical expense adjustment to be added back to SPL net accounting profit in deriving its adjusted profits? Okay, so first of all, we need under the medical expense, there are two or three things that you need to determine. One is whether is it portable or not portable. Okay, portable, will be the cap is if it's not will be 2%, but if it's not portable, then there's a cap of 1%. Number one. Okay, second that you need to determine is what goes into the employee remuneration. Okay, is it salary, CPF, directors remuneration, directors fee? Okay, what goes into the employee remuneration? And finally, okay, what are the item that is eligible that qualify as medical expense? Okay, is it does that include medical insurance? Does that include dental? Things like that. So you need to determine these three items in order to compute your medical expense tax adjusted medical expense fee. Okay, and I would recommend that you go to IRAS website, Google search, for the definition of employee remuneration and also the definition of medical expenses. Okay, so in this situation, we know that the employee remuneration okay, so this part, this is the total employee cost. Out of this total employee cost, okay, what is considered as remuneration? Okay, so over here you can see that employee staff appreciation event. Okay, 125,000. Okay, and staff appreciation event of 125,000, group gym benefits 30,000. These are not, okay, these are excluded from the total employee remuneration definition. Okay, so what that is included is only salary and CPF contribution of 6.5 million. Okay, and then the cap is 65,000. Okay, and then you look at what are the medical expense. The medical expense is 270,000. So you less away the cap of 65,000, then this 205,000 is not deductible. So you have to add it back as a non-deductible tax adjustment. Okay. Okay, so question 34. SPL filed a lawsuit against a software vendor for non-performance of contracted services and was awarded 8,000 as a compensatory settlement. SPL had originally paid 20,000 for the undelivered software service and claimed the entire amount as a deductible expense in its tax computation for a prior year of assessment. How should the $8,000 compensation be treated? Is it taxable or not? Okay, and the answer is yes, it is taxable. Okay, the reason is because it is relating, to a software expense. Okay, because previously, you had paid 20,000, for a software services, but the amount was not, but the service was not delivered. So what happened was that SPL then claimed a deduction. Okay, again, so since the SPL had already claimed a deduction of 20,000, now, okay, at the end of the day, the court awarded a compensation of 8,000. So he recovered $8,000 out of this $20,000. So since he had already claimed 20,000 as a deductible expense, this 8,000 would have to be brought to tax. Okay, clear? Yep. So in this case, you can see that the original software vendor was considered as a trading expense, given that this is part of his business cost, and then given that the $8,000 settlement was received in the same year when the revenue expense was incurred, so this have to be brought to tax. At the end of the day, the real exposure or the real cost to SPL for this transaction is only $12,000. Okay, so SPL can only claim a deduction of $12,000, but previously, since he had claimed a deduction of 20,000, he has to add back the $8,000. Okay, any question? No, then let's move on to question 35. Okay, so this question 35 talks about office furniture acquired. So office furniture acquired, in this context, is over here. Okay, and the amount is $3,000. So this is considered a low asset value. This is to test, your understanding of, low value assets definition and how you claim a CA against this low value asset. And the low value asset, I think you all know, right? The amount must be less than $5,000, number one. And number two, there is a cap at $30,000. Okay, there is a cap at $30,000. So you know that over here, 12 times 12 chairs, each costing the 3,000. Okay, so if you add up total, it's $36,000. Okay, $36,000 exceeded the cap of 30,000. Okay, so we know that only 10 chairs, okay, will be eligible for the low value asset deduction. Okay, and then the remaining 2 chairs, you would have to claim a CA under the normal 3 years, CA deduction. Okay, so as you can see from here, the total office furniture acquired is 126,000. Okay, and then the low asset value is 136,000 less 36,000 is equal to 90,000. Okay, so we know that to compute the low asset value is 3,000 of 12 chairs, which is 36,000. Okay, but you can only cap at 30,000. Correct? So the 2 remaining chairs will be, add together with this 90,000 and claim as a normal CA. Okay, so your total claim for YA 2026 is you have your low value asset CA 30,000. Okay, and the remaining amount, which is 96,000, you claim a normal 3-year CA. Of 32,000. So the total amount is 62,000. Okay, get it? Yeah. So what we are trying to do here is that what is the non-low asset value, which we all clearly know that is 90,000, correct? Okay, but out of the 36,000 of low value asset, there's a cap of 30,000. So the remaining 2 chairs, you have to throw it back to, as part of this non-low value asset of 96K, and then you claim a normal CA, which is divided by 3, and that is 32,000. Okay, so that is why your total CA is made up of 2 kind of deduction. One is your low value asset, and the other one will be your normal 3 years CA. Okay, so I don't think this is once you understand the concept here that you can claim a low value asset CA, then the rest will be quite straightforward. Okay. Then let's go to the next question. So 36,000, question 36, it talks about, what is the CA for the remaining assets. Okay, so over here, we all know that computer, server, and IT, you can claim a 1-year CA. So 360,000, 1-year CA. And then we know that there is a disposal. over here, there is a write-off of obsolete fixed asset with remaining tax written down value of $6,000. Okay, so we know that there is a loss of, there is a write-off of the obsolete fixed value of 9,000, means that there is no selling price. So given that the selling price is zero, okay, but then there's a TWDV of $6,000, so there is a balancing allowance of $6,000 that you can claim as your CA. Okay, and then the other part will be that you need to include the coffee machine, okay, and claim a 3-year CA. Okay, a lot of the time, I think students miss out step 3, okay, because there is a capital fixed asset item that has been, instead of capitalized, it has been expensed off in the P&L. So maybe from an accounting perspective, you can expense it off, but for tax purposes, you need to bring it to tax and then claim a capital allowance. Okay, so with that, after you add up all these step 1, 2, and 3, the total CA is 373,000, which is under here. Okay, so on question 37, it tests about your concept of section 14N. So whenever you see anything that is relating to renovation, it's really to test your concept on section 14N. And 14N, I think the magical numbers that you all need to remember is 300,000. Okay, there is a cap of 300,000. Okay, so with effect from YA 2025, when you have a section 14N, you can claim it within a year. Okay, you don't need to amortize it over 3 years. So for 2024, the company has spent 240,000 on renovation work. Okay, then for this 3 period, which is YA 2025, YA 26, and YA 2027, this 3 period, the maximum 14N deduction that the company can claim all in is 300,000. Okay, so since first year, it has already claimed 240,000, and then for the second year, okay, for YA 2025, it incurred a renovation of 120,000, but because there is a cap of 300,000, it cannot claim the full 120,000. It can only claim, 60,000 in YA 2026. So that's why, for the correct answer is for YA 2025, you can claim 240,000, and for YA 2026, although you have spent 120,000 renovation cost, but there's a cap of 300,000, so the balance that you can claim is 60,000. Okay, yeah, so I think that's the end of the assigned questions. So I know it's quite heavy, and I will, you all can go back and go through the questions again. In case, if you have any question, please, feel free to reach out to Iskar, and then Iskar can, consolidate these questions and send it to me, and I will try my best to to answer them back. Okay, so meanwhile, in case you have any logistic question or admin question pertaining to the coming TXF exam, feel free to ask in this call also, because we have one of the ISCA person, Jie Ying, who is also online, so she can help to address any logistic and admin question that you have pertaining to the TXF exam.
Sorry, can I have a quick question?
Yes, sure, please.
Like on question 7, is it the same that
Question 7, is it?
yeah.
Okay. Yes.
Is it the same concept that the other friend just asked, like about trade income? That is, if
Yes.
it's trade income is sort right?
Yes, correct. So long as it is trading income, you don't really need to consider whether is it received in Singapore or not.
Thank you. And also, will you give this PDF to, like, will you give this PDF to us? Okay, thank you.
Yes, Cassie, is it?
Hi, yes. So I wanted to check with Jie Ying regarding the during the exam, because when I was doing the mock-up, like the mock-up exam in the website, and I see that the instruction says we only can allow to open Excel during the exam. But while doing the question, I see the scenario on the left hand side is quite squished. So I wanted, like, can I use open a blank Word document to paste the
Yes. So
scenario?
any software on your desktop is permitted, meaning there is not AI, by the way. So like Microsoft Word and Microsoft Excel, they are all permitted. So you are able to use both of them to like do your computations and everything. What we do not allow in this case is any web-based ones, meaning if you want to use like Google Documents, Google Sheets, those are not permitted because you're not allowed to use the internet during your exam.
Okay, got it.
Yes, no problem.
Just now, I forgot who, the person who asked, is this PDF gonna be shared with us? I didn't hear the answer.
Oh, okay. So I've actually replied that in the chat. So the PDF that we shared today is not actually allowed to be shared because it's the explanation of the answer. So yeah, we're not gonna share that during for as a PDF, unfortunately.
Okay, thank you.
Can yeah. I believe you have taken your own notes during the session, so maybe if you have any questions based on that, if you're not sure of how to derive the answer, you can just drop us an email from the email that we have sent you for the facilitated study session, and then we can ask the facilitator to clarify and explain again if you're not sure.
Oh, great. Thank you both.
Okay, no problem.
Yeah, and maybe to really help you guys on your exam, although I'm only paid for only the assigned questions, but if you have anything that is outside of these assigned questions, that while you're attempting the rest of the question and you do not know why this is the correct answer or why this answer is like that, it's okay. Just feel free to, drop the ISTA team an email, and they can, come back to me, and I will help to clarify definitely.
Mm.
I think there are some questions in the
Questions in the chat as well. So, Charlotte, for the calculator models that ISCA permits, this will be any scientific model calculator, as well as I would say the basic calculators that usually people have. As long as your calculator you're not able to program or add additional programming applications inside, I think that is fine. Those that you can plug in, you can add in additional programs or softwares, those are not permitted. Yeah, that's all.
There's a cheat sheet question.
Okay.
Yeah.
Yes, for the A4 cheat sheet, you can refer to it during the exam.
Okay, Pastor, you only have 2 more minutes to ask whatever question that you. No, I'm just joking.
Hi, Miss Cassie. I just want to check, well, I have monitor in my desk, on my table. So while doing the exam at home, do I need to remove the monitor, or I just flip it, like the monitor face, you just face the wall? Is that okay?
Is your monitor able to be removed? Like, is it attached to your desk? Like,
Yeah,
Okay.
it's very difficult to remove it.
it's very difficult to remove. Would you have another room that you are able to take it in, or it's difficult to find another area?
Yeah, that's because I only have one room, so that's one.
Okay. Actually, it would be best if your monitor is not in the room. Maybe you can cover it with like a cloth or something to indicate like you're not gonna use it and touch it. Yeah, and then I think you can like turn it to the wall as well. So like just to leave it as far as you can from like your arm's reach. Like if it's on the same desk as you, preferably if it's at like the very side of the desk, like make sure that like it's not within arm's reach, and then yeah, just cover it. If you're not able to remove it, yeah, then I think that should be fine.
Okay, yeah, thanks.
Any more last questions? Okay, I think
No?
yeah.
Okay, then yeah. So thank you very much for spending your evening with me. Okay, so again, if you have any question, not restricted just to the assigned questions, just feel free to drop ISCA email, and then they can definitely circle back to me, and I will respond them accordingly. So with that, thank you very much, everyone. So all the best for your exam. Okay, bye bye. See you.